So EABL is back in the market just about 5 or so months after they retired. Early, I should say, their initial bond, and this time they're looking for 11 billion shillings. We're privileged to have the CFO, Risper Genga. Always a delight to have you.
Thank you, Julian.
So let's start with the pricing. And my issue with the pricing is that when I look at it vis-a-vis the sovereign 5-year, it actually looks quite impressive. But when I look at it vis-a-vis other issuances in the recent past, I think it looks like EABL might not have gotten the best price. What are your thoughts on this?
So, Julian, we've done an extensive amount of work around this. And part of what we did is we spent a lot of time speaking to the market players as part of the market sensing we did around understanding what to pitch, how much can we go for, and what rate to go for. And we listened to the players, and we also benchmarked against other sources of funding that we would have gotten for a similar structure. What came out is, one, there's a liquidity premium that applies to all because you are giving up your money for 5 years. So that's sort of a standard premium that everybody is applying because they're saying, well, you're going to have this money for 5 years. What rate can you give me? The second thing that played out is one of the things we prefer to do is to hold the option of redeeming early. A lot of the players, given the liquidity in the market, will treat this as held to maturity. So they price in the possibility that we have withheld the right to redeem this early should we choose to. It's not an option we exercise easily, but it's one that we want to keep in our benefit, that if there's an opportunity to gain from an early redemption, that we keep that in. So we think we've gotten a very good price. We've sensed the market quite in a lot of detail. We've sense checked against what we would get elsewhere from other options, and we think this is still the right thing to do. And we've landed a price that's good for the investor and good for EABL.
You retired your initial bond earlier than anticipated, and I thought to myself when I saw this investor memorandum that why couldn't you just roll that over as opposed to coming back to the market so soon?
So if one of the things that we highlighted, and I also mentioned this when we last spoke, that bond was at 14.95%. At current rates, that's a huge premium. And so we looked at it and we said we wanted to stay in the capital markets, but also it didn't make sense to continue paying 14.95%. We manage our cost of funds very carefully, and that was not what we felt was sensible for us to continue to do. So we retired it early, and we were also in the process, as you will see, this process of going into the market is an extensive one. And so we were also in the process of coming back into the market, something we've considered very intensely as a board, to say that this should work for us, we would go for it. Should it come at the right price, the right tenor, the right conditions? And I think it's also important as a corporate citizen to support our capital markets and create the opportunity to develop the capital markets.
And for sure, the capital markets did need this sort of issuance. Let's talk about the use to which this proceeds will be deployed. Particularly, I saw a mention of refinancing. Just give us a little more detail on that.
Okay, so if you look at how our portfolio of funding has evolved, same time last year, we had 11 billion in corporate paper, and then the rest of our debt was from the banking sector. Over time, as we've looked at what we need for the future and what tenor of debt that we have, we felt the need to prolong the tenor of our debt book. It was quite short, almost 2.5 years. And some of the things we've done, if you've seen some of the activity we've done in the last 2 years, we've done the acquisition of Serengeti, which was just about 6.3 billion in cash. We've done some projects around capacity expansion in Uganda and Tanzania, and our total capex over the 2 years has been about 16 billion. So that is really long-term sources, long-term funding use that really needs to be backed with long-term financing. So in looking at the structure of our debt portfolio, we feel the need to lengthen the tenor. So what this does for us is lengthen the tenor in that sense. And I think also keeps the mix that we've had of having some debt with the capital markets and some debt with the banks.
I'd imagine you've done some book building around this issuance. Just give us a sense of how the appetite looks like out there.
We've done a lot of book building. We had a lot of conversations, obviously, with the relevant approvals. And the sense is that liquidity is high. I think you do see that even with government and the issues they've done recently. And investors are seeking alternatives to places to put their funds. So the market is excited. I think our credit rating speaks for itself. So the market is excited about this opportunity. Liquidity is available, and the parties we've talked to, we feel are really quite interested. So we wouldn't go out if we weren't confident that we will be able to achieve what we want to do with this. So we've gone out and we feel fairly confident around this.
I spoke to an investment banker yesterday, and one of the things they mentioned is EABL coming in only to give us another early redemption, you know, before we anticipated. I'd imagine there's such a provision, and how does it kick in?
It's not an option that we take easily. We go into this because we want to take on 5-year funding, and that is what we go in for. However, if you look at the early redemption that we did, it was at 14.95. The market was somewhere around 11, 12. It was such a huge premium we were paying, and it just didn't make sense from a shareholder perspective to continue with that. So it's something that we would evaluate very closely. I think the investors have priced it in, quite frankly. So it is one that, as I said, we wouldn't do it lightly, but we do want to keep the right to be able to get the best value for the business as well.
I know you spoke to this a little earlier, and really the secondary market is not really within your control. But for those investors who would look at this in terms of an opportunity I take up, and then I could hopefully get to the secondary market and trade my note, how do you view the state of the secondary market, especially from a liquidity standpoint, and the ease with which it creates then such opportunities?
So I think two things. One, it's relatively quiet. I think secondary market trading on corporate paper has been relatively non-existent. I think with a wider pool of investors, which is what we wanted to see, is if we can get a wider pool of investors, then that might spur some activity. And also with more players like us coming on, then we are likely to see a lot more liquidity in the capital market, particularly for corporate paper. But that is something I think that, again, the investors price in. They price in the lack of liquidity and the inability to trade on the secondary market, which I think if we addressed as a community and as corporates and the capital markets players, would certainly make pricing a lot better and the capital market a lot more vibrant.